Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. This is Movers and Shakers, the show where I essentially break down all of the big movers from the previous month across the three different areas. We're looking at indices, FX, and commodities, and showing you what the best performers and the worst performance have been, and then charting them to try and gauge whether this could be a potential buying opportunity or something that we could sell into. Are we going to see a continuation of those moves, or is this setting up for a potential reversal? Let's start off first and foremost with what's happening in terms of the indices space. This is the breakdown for February 2024, the Nikkei 225 gaining over 9%. Massive outperformance for the Japanese index. And on the flip side of it, things not necessarily looking so rosy in South Africa, minus 2.48 decline for that index. In terms of how things set up from a charting perspective, here's the Nikkei 225. I want to start all of them with a look on the weekly time frame because it gives you a good idea of exactly how things are set up from a long-term perspective. And then let's get some of these historical levels drawn on off the back of that. So we can see, of course, we exited this consolidation zone at the turn of the year, and we've been pushing higher ever since. So January outperformance matched by February, and at the moment we're showing no signs of letting up, because if we then replicate that job on the short term, you can see these swing lows being established time and time again, and crucially we keep creating higher lows, never breaking through that prior swing low. The latest rally that we've seen to end the week has pushed back up through resistance of 39,642 to set a new high. That means that any move below this 38,889 level would essentially negate this trend that's playing out over the daily time frame. But until that happens, near-term pullbacks are there to be bought into if we're looking for a continuation of this trend, which at the moment looks likely. So this trend remains bullish. We haven't seen that breakdown through 38,889, and therefore the rally that has really dominated the beginning of this year looks likely to continue as things stand. We're yet to see a signal that this market is going to roll over. Next, we're looking at the South Africa 40. Here's again the weekly time frame. Let's just get some of these historical major weekly swing lows drawn on, and then we can play it from there. So essentially what we've been seeing more recently is this sort of stepped move lower. So you can see this decline in terms of these lower highs, and then on the bottom end here we've been creating these lower lows. Now you could say that this is a potential sort of ABC style retracement. So A, B, C, there is actually a tool for this kind of correction in TradingView, and that could potentially signal that this area here is a possible buying opportunity down here. But let's look exactly where it's come into from a fib perspective. Well, at the moment, we've tagged that 61.8 absolutely perfectly and started to move higher. Does that mean that that's the end of the sell-off? Not necessarily, because we're weakening at the moment. So there is still a possibility that we come into a sort of 5-leg move here. So you'd be looking at a potential move back down into your 60437, which is, or 60409, which is the 76.4 fib. So there's still risk towards the downside. For this to look more bullish, we'd need to see a break up through the 70721 level with the creation of a higher low. So we wouldn't want to break through the 63311, or we could flatline and find support on that level. But as things stand, if we start to drill down into the near term, we can see that rally faltered. So once again, let's get a fib on this top end of the move and see exactly where we came into. So we came into a nice deep retracement, and we've been rolling over since. The creation of that new lower low signaled the potential for this latest rally to falter. That's what has happened, and we've been rolling off over the course of February thus far. So we could see further downside over the near term. From a wider perspective, this area between sort of 60,000 up to 62,500 looks like an area where we could see the bulls come back into play if we come back into it once again. The long-term trend remains bullish, but we've seen a particularly difficult year just gone for the SA40, and at the moment there's still risk of further downside given this creation of lower highs and lower lows that have been playing out over the course of 2024 thus far. Getting back to it in terms of the FX space, we have seen outperformance for the US dollar. And that's it, really. We've seen many of the other currencies weaken. The strength of that US dollar and the dominance of that US dollar really shining through. On the flip side of it, the weakened end of the story, interestingly enough, has been the two other main havens, the Swiss franc and the Japanese yen, both losing plenty of ground. So what this really points towards is the idea that everyone's happy to be long a haven, but essentially with this realignment in terms of rate expectations, the only haven they want to be long is the US dollar. As we saw markets essentially shift from pricing a 7 rate cut 2024 period from the Federal Reserve to now pricing 3. And that almighty move has come to the benefit of the US dollar, but come to the detriment of many of the other currencies that it is trading against. In terms of the dollar index, we can see here that the weekly time frame shows this sort of consolidation, really, a lot of volatility over the course of the past year. But the gains that we've been seeing over the course of February really has been a continuation of the strength playing out over the course of 2024 thus far. We are starting to sort of stutter a little bit, and that's because market expectations are now at 3 rate cuts for 2024. The Fed's perspective, the outlook from the Federal Reserve is 3 rate cuts. So that job has essentially been done now. There's a good chance that this is likely to mark the beginning of the end for this strength for the US dollar. So are we going to roll over? Well, I think there's a good chance, but we haven't actually seen that come into fruition quite yet. A move through this sort of zone, swing low zone of 102.77, 102.9 would essentially point towards this market being sent back on its way and that bearish trend kicking back in once again. It hasn't happened quite yet. And so it brings into mind the question of whether this is another retracement here. So what have we come into so far? We've come into that deep fib zone between the 61.8 and the 76.4 fib. We started to regain ground. Has that really made any headway? It has, in the sense of that we have taken out this first swing high. And so really, if we want to see the bears coming back into play once again, we want to start breaking the 103.609 in particular to start sort of strengthening that story that we could head towards this key zone of support. So there's still question marks about, the ability of the Federal Reserve to be able to actually reach their target by June, which is when markets are pricing that first rate cut. And if they don't, are the Federal Reserve willing to cut rates in June, even if inflation isn't at target? That's going to be a key question going forward. I think there's a good chance that they are willing to do that. But if they come out with comments that essentially start pushing back on the idea that they could cut rates in June, and all of a sudden we start pushing more towards 2 rate cuts, that's where you could see perhaps another late flourish from the dollar index. But, if we're looking at the dollar here, further gains, I think, are likely to be relatively short-lived. And I think that there's a strong chance that we do gradually start to sort of roll over here. It can take a bit of time, but I do think that this dollar strength story is likely to wane a little bit as we go forward. But inflation is going to be really key. And remember, when we're looking in particular in terms of these FX markets, I may be showing you the dollar index and the Swiss franc index. But this, of course, really should be the basis of what you're thinking. If you want to go short a market, you want to go short the weakest currency against the strongest currency. All right. And so when we're looking at what's been the strongest, what's been the weakest, this should inform you into potential markets that you could be trading. Let's say, for instance, over the course of February, you were long the US dollar against the Swiss franc. Would have worked out particularly well because those are the two ends of the extreme. So really finding the strongest story and finding the weakest story is part and parcel of trading. And that's exactly what I'm trying to help you with here. So for the near term, the question mark of whether we break through the support is going to be key. The thing that could potentially give it a bit more legs is the question mark around inflation. So that's going to be really key moving forward. And then the weakest one that we're looking at in terms of the currencies has been a tight one between the Japanese yen and the Swiss franc, but the Swiss franc took it. And you can see here a big pullback. And this is why I was talking at the top end of the show about this idea of some of these markets we're looking for continuations. Some of them we're looking at the recent moves as being a potential setup for a reversal. And you can see exactly that here. I mean, ultimately, we're looking from a weekly perspective at a very clear uptrend, but we're seeing really significant swings in either direction. This latest pullback, therefore, could be another potential setup for the bulls. And you can see here we've come right into the 61.8 for the second time this week, and then the back end, the middle part of February. So, are we going to see this market start to turn upwards? Well, for the near term, we still remain within this sort of bearish trajectory. You could say this is almost a sort of slanted head and shoulders formation, but that peak giving way to this trend of lower highs and lower lows. So a break towards a downside would be looking at 110.86. But essentially, you wouldn't be trading the Swiss franc index. You'd instead be looking out for whether we think we're going to see that rebound for the Swiss franc or not. At the moment, we're finding support on that 61.8. That could be the support level to once again see this uptrend kick in. And so whether we hold on to that or not remains key. If we do, watch out for a potential breakup through this near-term area of resistance, 113.87, to give us greater confidence that the bulls could start to come back into prominence. But I would say if we're looking for further downside, there is the potential for it. But I would say arguably this story around Swiss franc weakness could start to ease off somewhat, given this wider uptrend that is in play, and given the fact that we've seen a relatively deep retracement and we're holding on to that Fibonacci support level thus far. So there's a possibility we could see the bulls come back into play in the not too distant future. And finally, let's look at things let's get rid of my head. From the commodities perspective, we can see natural gas, the big loser once again. And the other end of the energy spectrum, we can see that WTI and Brent crude both gained ground over the course of February. Is this the beginning of a period of strength for oil prices? Are we going to see further capitulation in terms of natural gas? Well, let's look into that. So WTI, first and foremost, let's just grab that chart and get my little head in again, because obviously we all want to see my little head. And what we've seen here in terms of the weekly time frame. So we've seen this pullback, and essentially you're looking at an area of support that has been respected around sort of $65 up to $70 for WTI. Bear in mind, we have seen in the past the likes of Joe Biden say that they would start filling up the strategic petroleum reserves around those levels. So the fact that we've seen it basing out around just sort of $70 mark should not necessarily come as a surprise. In terms of the daily time frame, we can see that the breakout that's come at the beginning of this new month has taken us up through resistance at 79,156. This looks for me to pave the way for a period of strength going forward and a potential extension of the strength that we've seen over the course of February. February was a strong month, but that's only because of exactly how it laid. You can see we saw that pullback coming into the month, but then we saw a strong end to the month. But we've seen a bit of chop, but I think there's a good chance that we've bottomed out here. We've still got the disruptions in the Red Sea. There's question marks around demand, of course, that whole Chinese story, but they are looking to implement some stimulus in the week to come. The question mark of whether that's going to do much remains. But we've, of course, still got the historic levels of production in terms of the US. But look, it seemingly found a bottom. And as things stand, this looks like we could be setting ourselves up for another period of strength going forward. The 4-hour chart shows you exactly that. So we're looking at this rally into resistance, consolidation, the rally up through resistance. We're now looking at closing candles here. So as long as we don't break back through your 77,486, it looks like there's a good chance that we could continue to push upwards, given the break through that 79,156 to create a 2024 high and the highest level that we've seen since November 2023. So WTI still looks pretty healthy if you're asking me. And then finally, we're touching on natural gas. Again, we've seen this capitulation over the course of 2022, 2023, or late 22, 23, big area of sort of consolidation over the sort of second half of 2023. But then we saw this big drop off at the beginning of this year. We're back down to historic levels, or we're trying to recover from historic levels. And the reason why we see these sort of massive percentage losses at the moment is because we've dropped off to such a degree. You can see these lows that we've seen back in March 2020. Now we're finding support on that level. So are we going to see a rebound coming into play? Well, at the moment, we've seen some strength. We saw a pullback. There's relative strength in that pullback as well, unfortunately. You know, it's much better when the counter trend move is relatively small in nature, which we're seeing at the moment. And so what you want to see to give us greater confidence that we're going to see the strong rally is sort of strong up candles, but relatively weak pullback candles. We've been seeing that strength on both sides at the moment. But there's definitely a chance that we do start to base out around these areas. So we're pulling back. If we break back below this 1657, 1586, then, you know, the bullish bets are off. But we found support on this historic level. We're at such oversold levels that this pullback at the moment could be a possible sort of higher low before we start to regain further ground. And of course, because it's been sold off to such an incredible degree, you know, you can see pretty significant percentage gains. I wouldn't necessarily be surprised if we're here in a month's time finding that natural gas is at the top of the pile, just because from a percentage perspective, you know, it's so cheap now that you're likely to get like multiples and things like that you're not necessarily going to get with some of these other markets. So major volatility expected over the coming month. Either way, it could be at the bottom of the pile, it could be at the top of the pile next time around, but we're seeing tentative signs of a resurgence here for natural gas. It was the big loser in February, but could we see it represent the big winner for March? That remains to be seen. As we're pulling back, we could see a potential area of support coming in around about your sort of 1.7 odd. Let's just grab it on the 4-hour chart and look at this from a sort of fib perspective. So we'd be looking for support around your sort of 1.72, 1.74 kind of area. So do we find that support? Do we break support? That's the key. That's a key thing to be watching out for here for a market that by and large has been a very difficult one for bulls and a very advantageous one for bears, given the consistent declines that we've seen over the course of this year thus far.